Hey, good morning, everyone. Marty Missouri here. It is Wednesday, the 20th of August, 2025. We'll call this a midweek update, but I've got a lot of stuff loaded up to share with you, and you don't want me to take as long as I could, I know. So I'm going to be pretty succinct and get the charts out of the way first. So again, I've been characterizing the technicals as heavy. I've been saying this market looks very heavy to me. You know, we're at all-time highs. We are not confirming those highs with our key momentum indicators. We've been overbought on a monthly basis. This is a daily chart, and I've shown you the history of that, and you don't want to get overbought if you're a short-term thinker with regard to the market, and even overbought a little bit or almost here on the daily. But more importantly are these negative divergences. These two indicators reflect underlying momentum. And these patterns, as I've shown you for years now, these rising wedge patterns are bearish patterns when we have divergences in momentum, which tends to coincide with a slowing, slope here. But, if you're a trader, you don't get a sell signal until you break below the uptrend line. You can see we did that 3-4 days ago. And then this momentum to the downside is not a great sign. This morning, the market is taking a pretty good hit, although it's come off of the lows as I speak. This 50-day moving average, I suspect, is where you're going to see some buying come in, if indeed we can get down to that level. And if we break through that with momentum because of some news, then the 200-day is going to be key. Ultimately, valuations, as I've shown you, do not support these patterns, do not support the notion that we're going to have an extended, protracted bull market ahead. Doesn't mean we won't. I'm just speaking in an historical context. So the daily looks very suspect. We're seeing some breakdown here. Same thing for the NASDAQ 100 index, very much so. This key 20-day moving average has been short-term support. You can see it sliced right through that, bouncing up a little bit against the 50-day. Just take a quick look at where we are right now. The S&P, as I speak, is only down 59 basis points, or a little over 0.5%. It was down 1% just a little while ago. And the NASDAQ is down 1.15%. It was down close to 2%. Clients, our core is actually up 0.12%, our core allocation this morning. And that would be thanks to gold miners, platinum, which we just recently replaced palladium with, a biotech company we own, Indonesian stocks, AT&T, silver, UK stocks, Argentina, gold, energy. So actually more than half of our positions are up. It's just the U.S. market. The tech sector in particular, which we're going to talk about in a minute, is taking a bigger hit. But we'll see how the day unfolds. The VIX was up about twice what it is now in terms of a percentage move. It was up 10%. It's up 5% now. And that's the implied volatility price into S&P 500 options. Okay, so the dollar. I remember down in here I said the dollar was due for a technical bounce. We've gotten that. It's kind of threatening these lows once again. I think this is more technical than anything else. In the interest of time, I won't belabor that. We get into other dollar impacting phenomena, but no doubt we will in the coming weeks. The 10-year was coming off the bottom here pretty notably. It was looking like it should. We had bullish divergences here, and this is the 10-year yield. When the yield goes up, the price goes down. You can see it's coming back off of this 4.35% level right here. Typically, that would be bullish the dollar and probably bearish the stocks, but that's going to also depend on the underlying economics. Gold continues to be stubbornly holding these levels. It's up pretty nicely today, which is helping us. Still below its 50-day moving average. That would be resistance right here. Wouldn't surprise me to see gold come back off the boil, particularly if stocks rally into the end of the week with Chairman Powell speaking on Friday at the infamous Jackson Hole Fed conference. Really negative short-term or daily chart for gold. Gold looks highly likely to sell off of this before this is all said and done, but we'll see. We're hedging our position currently. And then just a reminder, folks, about valuations. As I said a minute ago, I mean, this is the price-to-earnings ratio at the S&P, and it's in that very danger zone. This is the price-to-sales ratio, which is a better indication of valuation as far as I'm concerned, and it is at all-time highs, as is the market. And then price-to-book value is virtually at all-time highs, as is the market. I heard it said the other day, or I was reminded by somebody, that bottoms tend to be events and that tops tend to be processes. And that makes sense out of this kind of, topsy-turvy, always by the dip, from back in, even here, from back at the great financial crisis. I mean, investors have been trained, if they can weather some pretty steep declines from time to time, almost 30% right here, buy the dip, right? I remember, folks, back in the 80s, early in my career, I mean, I lived through the 87 crash, and that was a buy the dip scenario. I remember as we got into the 90s, even though I wasn't in my career in 73 and 74, I was in, grade school. I did a lot of studying of the past, and I would warn investors that, history says that sooner or later, buy the dip isn't going to work, and there's going to be something consequential. And so, we did a lot of study of valuations and, various indicators and so forth. Since then, we developed our own and still respect many others. But this is an area historically where you tend not to get, multi-year bull markets starting. In fact, the 10-year outlook for U.S. equities from these valuations is abysmal, and that's work that other people have done, and it's all based on history. Now, we have a new phenomenon, which is artificial intelligence, like we had a new phenomenon here, which was the internet, and I'm going to draw some parallels here in a minute. And maybe AI can bring the kind of productivity that brings earnings up significantly, up to the point where these valuations make sense. And that means that if earnings were to rise, these price to sales and price to earnings ratios are going to come down. I've been showing you charts that often they come down by way of the price falling, but they could also come down by way of earnings rising. Now, history doesn't give a whole lot of support for that. It gives more support for this, right? But we need to remain open to all possibilities. The market is betting on that non-empirical theory in terms of reasons why this PE would come way down to reasonable levels. That seems to be what the market's discounting, and that's what the market was discounting back here, as I'm going to get into. Okay, so I think I'll close with that AI.com comparison. And so let me just bring in just very quickly some other items I think worth talking about. So I just got off of a webinar with MRB, Macro Research Board, which is one of our premium research providers. They are bullish on the economy. They are bullish on inflation. They think inflation isn't going away. They think it's probably going up. And therefore, bullish on yields, bearish on bonds, which is in stark contrast to another main premium provider of research, BCA. They pretty much are on the opposite end of that scenario. They're looking at data weakening, and they think bonds are to be bought right now, that yields are coming down, and so on. Both do expect, as do we, the Fed to cut interest rates in September because the market is aggressively pricing in at least one 25 basis point rate cut. Data in August could change that tune. Chairman Powell's speech on Friday could change that tune or could change that discounting rate. But we'll see. Right now, without any new evidence and any new data from what we already have. And by the way, right now, the preponderance of the data really doesn't support a cut. In fact, MRB pounded that point home. They believe they're going to, but they don't think they should. They're in the camp that is worried about a last September reaction to a rate cut, and that would be yields actually popping, mortgage rates actually going higher. Those of you who've been watching the videos and recall, and some I talked to individually, That was our position back in September. I told my friends in the real estate business, this is not going to help you because the economy does not need a rate cut. And they got 2 cuts, a 50 basis point rate cut last September, and mortgage rates promptly went up by a full percentage point. It was just a bad thing to do. We're more sympathetic. We're more leaning toward BCA's argument that by September, we think the data is likely to justify a 25 basis point cut. I like what Fed Governor Raphael Bostic said the other day. He said, let's just give it a cut and then let's just pause and see and let it get absorbed, if it will, and just see what the data say, instead of this aggressive, we're going to cut 3 times by the end of the year, as a couple of board members, for their own reasons, are suggesting. I think Bostic's making a lot of sense right here. So I just grabbed a few slides. I don't know if I'll keep them, but MRB is making a point that fiscal policy, a la the big beautiful bill, is being very accommodative fiscal policy, along with potentially newly accommodative monetary policy, lowering interest rates and so forth. That's a setup in this environment for higher inflation. And that makes some sense based on the data that we've seen so far. We are thinking that we could see the data soften. This is something that I see every single week. Financial conditions are very easy, and they talk about, financial conditions indexes and so forth, global stock prices, Bitcoin, gold, and so forth. My focus is right here. Corporate credit spreads are incredibly low. I mean, you get very little premium for taking credit risk in corporate bonds. And what that means is that the market doesn't think there's a lot of risk in the economy that's going to raise, say, the default rate on corporate bonds. And that's just incredible to me, how easy conditions are right now. And if the Fed cuts into very easy conditions, MRB's right. We could see interest rates actually go up. So they say, don't be complacent on inflation. They show it actually bottoming everywhere, right? Not a time to be cutting rates in their view, even though they think they're going to. And then they kind of paint a picture that we probably have a stagflation backdrop. And that makes some sense to me. If we're right, then stagflation is probably the backdrop going forward for a while, because we think the economy is showing some signs of weakness, but inflation isn't necessarily going away. And remember, the government's going to be spending a lot of money, and if the Fed cuts into that, that could be a relatively stagnant economy with inflation. They talk about what asset classes do well in that regard. More on potential fiscal stimulus going forward. And then just basically the notion that the government is going to continue to borrow out the wazoo. This is a massive budget deficit, and the interest payments on the debt are a burden. Hence the big push from Washington to get the Fed to lower interest rates. I'll say it again, lowering interest rates on the short end of the curve could be problematic for markets because of what it will do to the long end of the curve and consequently mortgage rates and so forth. They plan to do most of the financing going forward on the short end of the curve. So if the Fed were to cut interest rates, you should see short-term rates drop, which will give the government an opportunity to borrow this massive amount that they're going to have to borrow going forward at lower interest rates. And we'll talk about the consequences of that as we go on too. And then I think I'll just make this the last one here. Peter Bookvar noted yesterday morning, or day before yesterday, the following, which essentially makes the case I made last Thursday's video about potential for inflation consequences of tariffs. It's a pretty common thought that it's just a one-off. And again, inflation is the gradual increase of prices. So if you just get a one-off tariff, or you get the tariff rate to go to 15%, well, they're not going to raise it to 17% next month. They're going to keep it at 15%. Therefore, tariffs are a one-time hit to inflation. But remember, I talked about mucking up supply chains, and I also talked about companies reluctant to pass it on at first, and they could do it incrementally. This is just support, and actually there's a Bloomberg article that I read yesterday that gives support for this as well, and it just makes sense. But anyway, just to let you know that I'm not just pulling this stuff out of my hat. Bookfar, I agree with the theoretical economic concept that a tax, a tariff in this case, is a one-time price event, but I'll also argue it's nuanced than that, as if supply chains get shifted, which is what I talked about. Barry Roth, who imports used cars from Canada for U.S. dealers, says he imported around 1,000 cars a month on average last year through November. In January, that surged to almost 1,500 cars as dealers tried to get ahead of tariffs. Remember, I talked about the impact of tariffs hasn't been seen yet because of all that inventory buildup. So they bought these before, and now they get to sell them at non-tariff prices. Now, as many cars from Canada face 25% levies, he says he is likely to import 400 vehicles a month. So that's going to incrementally push up the price. So that, again, just supporting a point I made about a week ago. My mind wants to take me to lots of other stuff here this morning, but of course I'll be doing more presentations for you. So let me just pull over. So I had a conversation with ChatGPT the other day, and I loaded an article I read from Bloomberg about CoreWeave and how they had very, very steep losses. Okay. Now, CoreWeave is a provider of computing power to customers like OpenAI, Microsoft Corp, and it has become a Wall Street favorite with investor optimism over AI. So here is, and hopefully I can just paraphrase the article, posted steeper losses as it continued to build to meet demand for artificial intelligence. Now, here's my question to ChatGPT. What's the risk in this whole AI narrative? It feels too much like the internet spending craze late 90s, which I lived intimately. Believe me, or I lived through intimately. So, CoreWeave, we are scaling rapidly as we look to meet unprecedented demand. The race to expand supply to meet demand will continue to weigh on profitability. The third quarter operating income will be $160 million to $190 million, which was referenced in the analyst call, compared with the consensus estimate of $192 million. The company is spending to expand, pouring funds into acquisitions, agreeing to buy data center operator Core Scientific for $9 billion, and data center expansions, including a pledge last month to invest as much as $6 billion. Okay, so second quarter revenue tripled to $1.21 billion. That's great. Ahead of expectations of 1.08, CoreWeave boosted its full-year revenue to $5 billion to $5.3 billion, while reiterating its capital expenditure and adjusted operating income forecast. Last quarter, its capital expenditures were $2.9 billion. Okay, revenue was $1.2, expenses were $2.9, and that's $1 billion higher than in the first quarter. Third quarter CapEx will be in the neighborhood of $2.9 billion to $3.4 billion. Okay, so the world's largest technology firms have continued to bet big. Of course, we know that, right? Microsoft, etc., Meta, Alphabet, so forth. With the latter, Alphabet saying it's going to invest $85 billion, roughly the equivalent of the market value of General Dynamics. CoreWeave said it finished the quarter, which ended June, with a revenue backlog of $30 billion. That figure has doubled year to date. Much of the demand is coming from customers using AI models. What am I doing right now, right? But it doesn't cost me hardly anything. We have seen a massive increase in our workloads that are being used for inference, yada, yada. The parallels you're seeing, and this is ChatGPT talking to me, and this is, by the way, I already know this, but I just wanted it to give it to me very succinctly in a very organized fashion, and just, look at data to see if I'm right. The parallels you're sensing to the late 90s internet boom are very real, and the CoreWeave numbers you cited are a good illustration of the risk side of the AI narrative. Heavy front-loaded spending with weak current profitability. I just made that case in CoreWeave's case, right? Demand assumptions priced as certainty. Literally, when you're listening to these folks, it's so reminiscent of the dot-com era. The AI is going to change the world, and it will. So did dot-com, but I'm going to talk about what happened when the bubble burst, right? Capital market dependence. You can see that we're going to have a massive amount of liquidity to continue to support all of this spending. God help us if liquidity dries up for any reason, right? And it says here, a higher interest rate or tighter credit environment where the cost of capital could spike. I talked about some risk of that a little earlier, just as happened when the dot-com bubble burst and funding dried up. Industry-wide arms race, cloud hyperscalers, Microsoft, Google, Meta, are also on record spending tens of billions on AI infrastructure. Overcapacity is a massive risk in my view. I've seen it happen. If too much compute comes online too fast, pricing power could erode, similar to the telecom fiber after 2000. Valuation and market psychology. CoreWeave shares more than tripled since the March IPO before this earnings drop. That's sentiment-driven momentum, which unwinds violently when earnings don't meet lofty expectations. In 1999, market leaders like Cisco were sure things for internet growth, and they were, by the way. But overpaying for growth at the wrong point in the cycle led to decade-long underperformance. Cisco, by the way, was I'll say the NVIDIA of the Dotcom era. They were the guts. They were the engines, the switchers and routers and so forth for the internet. And they were going to make money throughout, and they were going to change the world. Stock went down 80% when the bubble burst. CoreWeave specific twist. We can skip that one. Bottom line, the risk isn't that AI won't be transformative. Unequivocally, it will. It's becoming more and more meaningful for us every day, I can attest. It's that public and private capital front-loading 5 to 10 years of infrastructure into 1 to 3 years. If monetization lags, if they don't make money on it right away and workloads shift, the sector could face the same overcapacity, funding crunch, and valuation collapse the internet infrastructure players saw post-2000. Here's a side-by-side dot-com boom versus today AI build-out. The early narrative, 1994 to 96. Yeah, the Netscape IPO, Yahoo mania, first wave of web adoption. Investors extrapolated exponential growth. They're doing that now. Today, the AI boom, ChatGPT, viral AI demos, massive venture capital and public inflows. Parallels both began with consumer visible breakthrough that caught mainstream attention. Massive interest spend. 97 to 99, telecoms and dot-coms raised billions to lay fiber, build data centers, yada yada. 23 to 25, hyperscalers and startups, CoreWeave, etc., spend billions on GPUs, data centers, and trainings. CapEx running far ahead of monetization. That's the parallel. Peak hype. 99 to 2000, PE ratios over 100 times common. IPOs triple in a day. I can remember it like it was yesterday. 2024 to 25, infrastructure names triple in months. Valuations imply sustained exponential AI demand. Parallels overestimation of speed, not eventual scale of adoption. Overcapacity signs. Telecom, fiberglass, bandwidth prices collapse. Potential 25-26, GPU DC oversupply efficiently gains cut workloads. Fixed costs plus excess capacity, margin compression are all the parallels. Funding crunch potential. 2002, capital markets seized up, refinancing unavailable, bankruptcies cascade. Potential trigger, higher interest rates, risk-off turn, or AI workload slowdown. High-burn infrastructure players are the most vulnerable. Shakeout and consolidation, 02 to 04 survivors buy distressed assets. The winners were Amazon and Google. Amazon, by the way, went down 90% in that 30-month period. Future cash-rich hyperscalers, Microsoft, Google, Meta, they're going to survive. And they're going to have a heyday if and when this happens. But their stocks are not going to be spared, I can assure you. Consolidation, eventual durable winners. I couldn't agree more. I think AI is huge, just like the internet was. Okay, so key risk drivers today, again, overcapacity. If multiple hyperscalers plus CoreWeave type scale players all hit build targets at once, GPU hours and inference prices could fall faster than expected. Funding risk, CapEx heavy growth depends on cheap debt and supportive equity markets. Demand mismatch. Current revenue is mostly training and early inference. If customers shift to more efficient models or on-premium compute, demand growth may decelerate. Customer concentration. AI players often rely on a handful of mega clients. One pullback could hit revenue hard. Valuation compression. Even if revenue keeps growing, the market may re-rate multiples because they are crazy right now. So the lessons from the dot-com crash that we need to be very, very cognizant of. Narrative truth does not equal investment timing truth. And that, talk about buying the dips and so forth. We shall see, before this all shakes out. Winners still suffered huge drawdowns. I just mentioned that, right? Include Microsoft into the two I mentioned. Liquidity is oxygen. Oh my, that's for markets in general. The liquidity begins to dry up. Look out below. Bottom line, we're likely still in the infrastructure land grab phase of the AI cycle. equivalent to the 98, 99 stage of the internet build-out. If this parallel is perfect, and it's not, then there's still more room to run, right? 1998, we got a 20% blip. It was a warning sign when long-term capital management went under, when Russia defaulted on its sovereign debt. The market went down 20%. Remember, in 2022, it went down 27%. Different dynamics, of course. And then we came screaming back in 1999, by the way, to the chagrin of some clients who thanked us later. We were cutting our tech exposure in here. And then it all came roiling down. The NASDAQ went down 80% from the peak in 2000. But there was still more room to run. If the parallel is correct, there's still more room to run before AI struggles. The core risk is time mismatch. Infrastructure is being built for a revenue ramp that may take longer to materialize, and capital market patience can run out fast. So folks, let me be on record as saying, I do think the world is different this time. The political will and the capacity to print previously unthinkable amount of monies to paper over problems will be brought to bear in the kind of crisis that I'm kind of alluding to or fearing right here. Okay. So the odds of a 30-month contraction in markets, in a market so economically important as the U.S. tech sector, the hit that it would have in the financial sector and to the consumers and so forth, and the disinflationary impact of that at the same time because of what the economy may be doing, will bring a tremendous amount of stimulus to bear. No ifs, ands, or buts about it. And it'll be on the fiscal side as much right now, more so probably if it were to happen soon than even the monetary side. And that would just be government carpet bombing the economy. Yeah, it does set up the real basis for our longer term thesis, and that is a weaker dollar, and that is a very inflation-oriented investment theme, weaker dollar theme, economies that produce resources and that sort of thing. We do believe we may be at the early stages of the next commodity super cycle. The massive U.S. debt to GDP and the problem that higher interest rates and inflation will cause for that brings in a scenario that I've illustrated for you multiple times over the last few years, and that's a post-World War II scenario where the Fed does essentially yield curve control. That is what the government, by the way, in a sense, is trying to force upon them right now. Despite what you're seeing in the data, get rates down, right? What the Fed did in the early to mid 40s all the way to 1952 is they capped the yield curve at 2.5%, allowed the government to refinance all that war debt at a relatively low level and allow inflation to run hot, which inflated GDP. So we ended up in 9 years bringing the debt to GDP down from 116% down to about 80%. No more yield curve control, but by the time Volcker started raising interest rates in the late 70s, we were only 30% debt to GDP. So some form of yield curve control probably is the answer, and that sets the stage very nicely during the next cycle for how we expect to be investing. So that's our thesis right now. Always subject to change. We rework it all the time based on data and based on the reality that we currently live in, which is a different reality than the late 90s. So I don't know that we need to fear an 80% hit to the NASDAQ, but, sure, a bear market that brings valuations down to reasonable levels is a very distinct possibility sometime over the next 6 to 18 months, I would say. So from our perspective, again, I keep reiterating that we've had a really good year so far. Of course, we want to keep that alive and do the best we can, but we have to have an eye on risk right here and continue to hedge and be uber diversified on a global asset allocation basis. Thank you, folks, for staying with me that long. I hope that was interesting for you. I'll be back later in the week. Hope you have a great rest of your day. Take care. Bye-bye.